What you have to know is that if you are preparing group accounts, whatever be the case, you are going to be putting two statements together as if they are two statements of two entities or two or more entities as if they are single economic entity. So you don't have to go and start doing anything to the additional information. No. Yes, whatever be the case, you'll be putting two statements together. So identify who the parent is and identify who the subsidiary is and go and add their figures first before you come to the footnotes. So this is financial reporting. The basics is financial reporting. The first company will always be the parent, and the second one will be the subsidiary, and the third one will be an associate for corporate reporting. Okay, but for financial reporting rather, for corporate reporting, the first will always be the parent, the second will be the subsidiary. The third can also be what we call a sub-subsidiary or a subsidiary itself. Okay, but for financial reporting, the first company will always be the parent, the second will be the subsidiary, and the third will be an associate. So it doesn't matter when the acquisition is done. If I bought your company on the last day, you are not the owner of the company again. I'm the owner. So for statement of financial position, it doesn't matter when the company is being purchased. You are going to be putting the two figures together, line by line. So this question, you know that is statement of financial position. You can just go ahead and put your statement of financial position there. And put your statement of financial position there. And so let's see the name of the, okay. So the listing will be Tangent Co. So that is a parent. So you can just put your Tangent Co group here. Then you have the statement of the statement of financial position. Financial position as at what is the date there? 31 March.
31st March.
Okay. So 31 March 2026.
2006.
So we have 206. Okay. So you have your currency sign here. Are they having 3 zeros at the top?
Yes.
So they are having 3 zeros at the top. Okay. So you come to your assets. Another assets. And the first one that will come will be non-current assets. Right. What is the first non-current assets?
PPE.
Okay. So we have property, plant, and equipment.
PPE.
Property, plant, and equipment. What are their figures?
75,200.
75,200 plus what?
31,500.
31,500. So the second one is investments in admin. Okay. What is the value there?
4,500.
4,500.
4,500. Okay. Okay. They don't have any other non-current asset, but you can leave a space like three spaces. You might have goodwill. The goodwill will come there. So you can leave like 3 spaces there and come to the current assets. So the current asset, let's see. Okay, we have inventory. So the inventory, what is the value?
19,400.
Okay, plus what?
18,800.
18,800. Let's go to the next one. The next asset is what?
Receivables.
Okay. Receivables,
14,700.
14,700 plus
12,500.
12,500. The next one is what?
Bank.
1,200 and 600.
1,200 and 600. So you come to your equity and liabilities. Please, the equity we only bring the what? The parent own, because all the equity items of the subsidiary will be net against the investment. You'll be having investments in the parent accounts. So the investment will cancel the equity component and the difference will be the goodwill. So the equity we bring only that of the what? Equity items. The subsidiary's own will be consumed or will be cancelled with the investment, and the subsequent one will be shared among the parents and then the NCI. So we bring only the equity items of the parents. Okay, so let's have the equity shares there. The equity shares. Okay. What is the value for the parents?
50,000.
Okay. So you come to return earnings. The return earnings, we always do workings for it because a lot of items will be affecting it. So adding in the brackets, the space might not be enough for it. So the return earnings, you go and put it there. So you come to NCR. That will be the portion of the shares of the subsidiary that is not being controlled. So we come to the NCI. After that, you go to your non-current liabilities. Okay. Do you have any non-current liability there?
The loan note, 8%
We have
loan.
Okay. 8% loan notes. Okay. Since you are here to read the footnote, you always have to leave a space, some spaces before you move on to the next item, because there might be a new item in the footnote that might be affecting that might be classified as any of these ones. So we have 5,000 for these people. So 5,000. Then we now come to current liabilities. The current liabilities, we are giving only one figure. Okay, 24,000 against 16,000. 24,000 plus 16,400. Please, nobody should lie to you that you have to go and do workings. You can be doing the workings, you will never finish. And some of the footnotes are not for you. So add your figures and move on. Add Just put the skeleton there. At least you have gotten like at least 10 or 15 ticks already. Yes, they will mark the figures one by one. So you just ask yourself, okay, what is the next step? You count your workings. Okay, you count your workings. The workings, what you have to do first is the group structure. Very simple to put there. You don't have to come and struggle. Okay, so the group structure, I'll be showing you the the easiest format. Okay, so you can just put it in a table form. Nobody's going to do anything. So you can just put a group structure in a table form. So we have the tangent code there, the tangent code. Then you have the name of the subsidiary. What is the name of the subsidiary? It's Latrico. Okay, so you can put a table here. Then you have the Latrico. Okay, let me just put something here like this. So you have the Latrico here. The Latrico. Then we are also going to be having the Amico here as an associate. Okay. So you can just underline these people. Okay, let me do it very well. So let's come to the percentage holding here. Okay, so let's come to the holding. Let's go to the question now. Let's see the holding that the parent is having in each of the two. Okay. What is the parent percentage holding in the subsidiary?
75%.
75.
Okay. Then we come to the associate was purchased some time ago. So let's come to the associate is what 30%. Okay. The footnote 4. So that is 30%. Okay. Please, there is no format for this particular group structure. Okay. So you can just put it in a table form and move on. Okay. So let's come to the date of acquisition. The date of acquisition is very important. Okay, let's go and see when the investment in the subsidiary was acquired. What is the date?
1st January 2006.
1st January 2006. So January 1, 2006. What about the associate? Let's check the associate acquisition date. The investments is capital Using equity accounting method and this and this. This one, they are not giving us the date. So
So in the financial statement, you have 1st April 2005.
this is the equity this thing that they have used. So that is the opening balance. They might acquire them some time ago. Okay. So that is not the acquisition date. But since that is the only date that you have there, then you can just put it there. So that is the balance at the beginning of this year. But they might be acquired a long time ago. So this one you can just put that here. We don't know. Okay. Let's look at the reporting date. Reporting date. The reporting date is 31 March, isn't it? March 31, 2006. This one too, we don't know. So we move on with the dash. Then you now come to what we call post-acquisition period. Post-acquisition period for the subsidiary.
3.
That will be 3 months. Okay. So the post-acquisition period is from the date of acquisition to the reporting date. How many months or how many years is that? So the post-acquisition period, you can just put it over here. Post-acquisition period will always be, that will be 3 months for these people. And the other people we don't know. Okay. So you now come to your 2. You are going to be determined for goodwill. You are going to be determined for goodwill, and you're also going to be looking for what we call the post-acquisition profit. So the only thing or the easiest way of doing that is to prepare what we call the net asset table. So you have to determine the assets at the date of acquisition, the net assets at the date of acquisition, and also the net asset at reporting. The difference between them will always be the post-acquisition profit. So we are going to be looking at that, although I'll be showing you another way of calculating the post-acquisition profit. So for me, if I'm doing it, I don't really prepare the net asset table. What I'll do is that I'll prepare them in a different format. But let me just write the net assets here. The net asset will always be for the subsidiary because you want to know the net asset of the subsidiary. Okay. You can also do that for the associate, but for this question, we don't have any information like that concerning to the associate. So you have at acquisition, and you are going to have at reporting.
Please, why is it that we don't put the subsidiary's name, but rather you written subsidiary?
You can put the name. There is no problem. Okay, so you can put the name there, but the easiest way for me is just to put the subsidiary there. Okay, so you can put the name of the subsidiary, but those names, they are not common to me. So I'll have at acquisition here and as reporting. Okay, what I do is that I don't normally put the post-acquisition profits there. At the end of the day, I'll just find a total between them. So that is what I normally do. So, but if you like, you can put the post-acquisition profits there. But what I do is that I always find a difference between the two figures. Okay, we say this is net assets. So the format is what we calculate it from the equity side. So you ask yourself, what is the stated capital at the date of acquisition? Okay, the stated capital at the date of acquisition will be the same as at reporting because we don't want a change in the percentage holding. We want the parents to have what? 70% holding throughout. So there should not be any new issue of shares. There should not be any repurchase of shares because if this thing happens, it is going to cause a dilution in the ownership. So we are still maintaining the 70%. So it means that the equity shares of the subsidiary should be the same at reporting and also at acquisition. So they'll always not give you that the stated capital is this. No, the reporting figure will still be the same as what acquisition, because we want the parent to maintain the same percentage holding. So there will not be any issue of additional shares or any issue of or any repurchase of additional shares or any bonus issue. There's not going to be any issue. So it will still be 20,000 at acquisition and 20,000 as reporting. So we have the 20,000 here and the 20,000 here. Okay, the next equity item is the retained earnings for the subsidiary. Okay, this is where you have to now look at how to calculate the retained earnings. Look at the retained earnings given to you here. You are giving the opening balance and you're also giving the profit for the year. So whenever they say for year end, that is a profit for the year. Okay, you are giving the retained earnings at the opening, or the opening balance or the retained earnings, and you're also giving the profit for the year. Okay, the question that you have to ask yourself is that when are we preparing the statement?
31st March
Okay,
2006.
when was the acquisition done?
1st January 2006.
Okay, how many months to the reporting? How many months to the reporting before we acquire them?
9 months.
Okay, so it means that the retained earnings at acquisition should be the opening balance plus 9 months profit. Okay, because the only time that we didn't acquire them, this figure over here, this 8,000 over here, is the profit for the year, which is 8,000. This profit is representing 12 months. Okay, but this balance is the one that they have at the opening balance. Okay, they have already operated for 9 months before we acquire them. So the profit at acquisition should be the opening balance plus the 9 months, of this. So we acquired, and the post-acquisition profit, the post-acquisition period will be 3 months. So only 3 months of this will be available to be shared among the parents and then the NCI. Yeah, Senior Nathan, also.
Yeah, Sine, I beg, take over this one again for me.
Okay.
The retained earnings.
Okay. The retained earnings you are giving retained earnings at 1st April 2005. That is the opening balance. Okay, that is the retained earnings from the previous period. They also are giving you for year end. For the year end is the profit for the year. So for you to determine the retained earnings at acquisition, ask yourself, when was the acquisition done? The acquisition is done on 1st January. Okay, but with the reporting period is 31 March. Okay, so it means that their financial year starts from 1st April. So from 1st April, they started operating from 1st April for this current year up to 1st January before we acquired them. It means that we didn't acquire them at the beginning of the year. We acquired them somewhere into the year. So they started operating from 1st April. We acquired them on 1st January. So 1st April to January is 9 months. So it means that they have already done 9 months before we acquired them.
Okay.
So their retained earnings will be the opening balance plus 9 month profit that they have already made.
Sir,
Yes, please.
please, 1st April of the same year or?
Yeah, 1st April of the same year. Their financial year is 31 March, so April to March. So it will start from 1st April 2005. That is where they are reporting their financial year starts from 1st April 2005, and it will end 31 March 2006.
Okay.
Okay. So they started operating from 1st April. We acquired them 1st January. They have done 9 months already. So it means that they have made a 9 month profit already before we acquired them. So what will be the retained earnings now? It will be the opening balance plus 9 months of the profit for the year. Okay. So the retained earnings is always a problem to So it's always, if you want to compute it, that is always a problem. For the equity share, there's no problem with that. Okay.
Please,
Yes, please.
yeah, to the best of my knowledge, we are taking that portion of retained earnings because we bought them and they've operated for that period.
We
Is
are
that
not,
it?
we are not taking it. We are adding it. They have done 9
Yeah,
months.
that
Okay.
we are adding it to the previous one.
The opening balance.
Yeah. Is it because we bought them before they've operated? That's why we are taking that, we are adding that portion, or is because they've operated before we bought them?
We are looking for the retained earnings at acquisition. And when is the acquisition? 1st January. So it will be
Okay.
the retained earnings at 1st January. How do we get the retained earnings at 1st January? We have the opening balance plus the 9 months profit that they have already.
Opening balance, which they've operated before we came in.
Okay. And they have already operated for 9 months before we came in.
9 months. Okay. Before, in addition, before we came in. Okay.
Yes, please. So the 9 months should be added to the opening balance. There.
Okay.
Okay. So you can calculate
So
the.
in actual fact, it's the pre-operating retained earnings we are looking for.
Exactly. That is what we call the retained earnings at acquisition.
Oh, okay.
Yeah. So the easiest way to do that is that just find 3 months profit and take it from the total, or you can add 90 and 8,000. That will be the total retained earnings. So then you just take 3 months out of it, or you just put the 19,000. Then you add the 9 months of the 8,000 to it. Anyhow you do it, you are going to be. So we have 19,000 plus 9/12 multiplied by 8,000. What are we having?
Total will be 25,000.
25,000.
Okay. The same way, someone can also do 19,000, 8,000. That is the total retained earnings at the end of the year. But there is a post-acquisition profit of 3 months. So you just calculate 3 months and take it from there. You'll be getting the same answer. What will be the retained earnings at the end of the year? At report.
27.
Okay. 27,000. Okay. You can see that there is a profit element of 2,000 there, which is for
Yes.
the 3 months. Are you okay? All right. There's a profit of 2,000 there, which is the 3 months profit. So we have the 27,000 there. Let's come to the next item for equity. I'm not sure they have any other equity items. They can have revaluation surplus, they can have share premium, they can have other components of equity. All those things should be what? Should be determined at acquisition. All right. So they don't have anything again. Let's move on to other things that can help us to move fast. So you can leave these ones and now move on to, okay, this is net assets. You can put something like goodwill calculation here, but you won't do anything. You just create the space for yourself so that you can be able to work fast. So you have the goodwill calculation. Because you are here to determine the purchase consideration, you move on. Let's come to the 4, will be the non-controlling interest. So do you have it over there? If you don't have, then you just leave it. The second or the other item that you can easily determine is the group return.
Hello, sir.
I can hear you, please.
And please, sir, the retained earning at
Can you talk again? Can you?
yes, sir.
Yes, please.
The retained earnings at reporting, the figure 27,000 is in the footnotes.
No, please.
Or the opening is added to in the closing.
Yes.
Yes.
Okay, thank you.
So let's come to the group. The group return is you don't have to suffer before you get it. So you can just go and determine your figures and put it there. Okay, what is the group return earnings? What is the return earnings at reporting for the parents?
20,000.
Are you sure?
Our reporting is 36. At opening is 20,000.
Okay. So the reporting for the parent is an entity that is operating on its own. Okay. So you have the group return earnings is the return earnings for the parent. That will be the opening balance plus the profit for the year. That will give us 36,000. Okay. So after identifying these things, there is no plan. These are the things that you'll be doing. Okay. So you can just create a space for them and move on. Don't say you want to waste your time or you want to focus on one thing before you move on. Okay. So from this place, you can ask yourself, which of these things am I going to be? Which of these things, which of these footnotes that are going to be very simple for me to what? To deal with. But since we are learning, I will just start from the place that we can start from. But if in the exam, you just scan through the footnotes and see the ones that are going to be very simple for you to adjust. Okay. I've forgotten to bring one item here. We also have investment in associates. So if you look at the question, we have investment in associates there. Okay, so you have the 6 here. We have investment in Armory. Okay, so we have the opening balance. Then you have your balance go down here to be 4,500. Okay, then you now go and start what? Looking for things that you can easily what? Adjust. Okay, let's start from the top. Let's start from the top there. Who is taking the top first?
On 1st January 2006. On 1st January 2006, Targent Co. acquired 75% of Latrico equity shares by means of a share exchange of 2 shares in Targent Co. for every 3 Latrico share acquired. On that date, further consideration was also issued to the shareholders of Latrico in the form of 100 cedis 8% loan note for every 100 shares acquired in Latrico. None of the purchase consideration nor the outstanding interest on the loan note at 31st March 2006 has yet been recorded by Targent Co. Date of acquisition. The share price of Targent Co. and Latrico is 3 cedis 20 pesos Ghana cedis and 1 cedi 80 pesos Ghana cedis respectively.
Okay, stop there. So let's tackle that one. So how is the purchase consideration settled? What are the forms that they are using?
Share exchange.
They are using share exchange and which one?
Loan note.
Okay.
Loan.
They are using share exchange and loan notes. Okay. What is the proportion of the share exchange?
3. Okay, 3 is 2.
2 for 3.
2 for 3, isn't it?
2 for 3, yeah.
Okay. So you first of all have to ask yourself, what is the number of shares that the Latrico is buying in Targent Co is buying in Latrico? What is the number of shares for the Latrico? What is their number of shares?
20,000.
Okay. You can see that this is the value, but you always have to find the share. So this is 1 cedi. So it means that will be 20 million shares.
20,000.
Okay. They can give you 0.5. It means that the number of shares will now be 14 million. So you have to, don't look at this is value. The 20,000 over here is a value. Is the number of shares multiplied by the share price. That's why you're having this. So you first of all have to determine the share that they are buying. So the share that they have is the total number of shares is 20 million, but they are buying only 75%. So what portion of that will represent the 75%?
15,000.
Okay, so that will be 15,000. So what you do is that you now go to where we have written the calculation of goodwill. So you put your purchase consideration there. Okay, you put your purchase consideration there. Okay, purchase consideration. You now have share exchange as the first one. So share exchange. So the share exchange, what is going to happen is that we are having 2/3. Is that correct?
Yes.
2/3.
Yes.
Okay.
Yeah.
Multiply by 0.75 multiply by 20,000. Is that correct?
Yes.
That's correct.
Okay. We are buying only 15,000 and we are saying that bring 3 of your existing shares for 2. So it will always be 2/3 multiplied by the number of shares that we are buying. We are not going to be issuing shares to all the total shareholders. We only issue the shares to the portion of the shares that we are buying, which is 75%. So what will be the number of shares that we are going to be getting from the
10,000.
10,000.
okay? And we are not interested in the number of shares. We are interested in the value because we are going to be recording this. Okay. So the 10,000 will be valued at what?
3.2.
Okay. The shares are for the parent, so it will always be valued at the parent's current market price, and that will give us 3.2. What are we having?
32,000.
Okay. Okay. What will happen to the parent equity shares? They say this has not been recorded. So what will happen to the parent equity shares?
It will
Will
reduce
be
them.
high.
Okay. So that will increase the shares by 32,000. The entry should be debit investment and credit the equity shares. So we bring in the investment over here. This has not been recorded. This has not been recorded. So we are now. Yes, please.
Sorry, about the 2/3 is from where?
It's from the top there. See, 2. They are doing a share exchange by means of 2 for 3. So we have.
Okay.
All
Okay.
right. I'll leave a space here about.
Say,
Yes, please.
hello. Say,
I can hear you.
please, the share exchange that we did, the 32,000.
Please, I'm with you.
I wanted to know if the 32,000 will be other component of equity that.
We are issuing shares, not
Okay.
other component of equity. All right.
Please,
Yes, please.
can you go to the parents' equity share? Let me see something. Equity and liabilities. Okay. All right, sir.
Yeah, Deborah.
Hello, sir.
Yes,
So
please.
I want to understand the 32,000. Is it that the parent company is getting that 32,000 from the subsidiaries since they don't have money to pay them?
They cannot get that money from them. You are buying something from me and you don't have money. You are giving me something in return. So I'm giving you something, you're also giving me something. So it's not that they are issuing the shares they are going to buy. No. You are buying the company, you are buying the shares of the company. You need to pay them cash of 32,000. You don't have the cash. You are now giving them a share that's okay. Since we don't have the cash, we are going to issue you shares in return for what? For the whatever we are taking from you. So that is why they are giving them the 32,000. They should have given them a cash of 32,000, but they don't have the cash. So we are using shares to pay you.
Say, I understand.
Yeah, Deborah, I'm waiting for you.
Sir,
Yes, sir, I've replied in there. Yes, I'm okay. Thank you.
All right. Yeah, Roxy.
so was it this aspect that you were referring to, that anytime we are being given share issue, we shouldn't assume that it was existing shares that were issued, but we should assume that they are new shares?
It should not always assume they are giving new shares. The question is not say that the existing shares of the parents are going to be living. The existing shareholders will still be there. So new people are coming in. So it will not be any assumption. They are issuing new shares. They are not issuing the existing shares. Nobody is going to be leaving the company. The existing shareholders will be there, and their number of shares will be 50,000. That is the 50,000. The shares that they have before the acquisition is 50,000. Those owners will still be there, and we need to acquire. So we have to issue additional shares to be able to purchase them. We have to issue additional shares to be able to do this. And I also say that the best way to assume is that you assume that they have issued the shares for cash and they are now using the cash to pay those people. At the end of the day, your entries will still be debit investment and credit your equity shares.
All right, sir, thank you. Sir, please, with the group structure, I think you forgot to bring NCI.
Okay, that is not the issue is not about that. So we have the NCI of 25%. Okay, those ones they are okay. They're also easy tips that you get. No problem. Okay.
Senior Adams.
Yes, please.
Yeah. So as you are back to the group structure, I think they have a date of the Ameco company. So the investment date is 1st April 2005.
Who is lying to you?
If you look at the asset, the non-current asset, they say investment in Ameco at 1st April 2005.
And that is why you think that is a date.
Yes, please. I'll stand to be corrected.
You will be corrected. Don't worry. You'll be corrected. Okay. Look at the IV. The investment in Amri could represent 30% of its voting share capital, and Sergeant who uses equity accounting to account for these investments. Amri school profit for the year ended 31 March 2006 was 6 million, and Amri could paid total dividend during the year ended 31 March 2006 of 2 million. Sergeant Co has recorded each share of the dividend received from Amri Co in investment income and cash. So because of this treatment, the investment has been there since. So they are using what we call the equity accounting. So that is the balance brought down, not the actual investment.
Okay. Because I look at the balance sheet.
If you put the first April over there too, there's no problem. But that is not the acquisition date. That is the balance brought down for them. Are you okay?
Okay, thank you.
So let's go to the next purchase consideration. Since we are done with this one. The next one is what? A further consideration was also issued to the shareholders. Yes, Naibi.
Hello, sir. Sir, I was asking with the equity shares, even if the question did not tell us that it has not been recorded, you still have to add it to the equity share.
Unless you have been told that this has been recorded already.
So if it's silence on it, we have to add it.
It has not been recorded. Okay. Further consideration was also issued to the shareholders of Latri Co in the form of what? 100 CD 8% loan note for every 100 shares acquired in Latri Co. So we are giving them, the share exchange is not enough. We have to give them loan notes now. So, okay. So we are going to be having the loan notes. Okay. So the loan notes, we are giving them what? 100 Ghana cedis for every 100 cedis shares acquired. How many shares were acquired?
15,000.
15,000.
Okay, so this 15,000 over here, we are giving them 100 shares for every 100 what? Ghana cedis. So that would be, so you just do how many loan notes are you going to be getting from the 15,000? You are giving them 100 what? 100 shares for every 100 cedis loan note. Loan notes are issued in units. So every unit is 100 cedis. So how many units of the loan note are we going to be issuing? A loan note is 100 shares. We are acquiring 15,000 shares. So it will be 15,000 divided by 100. That will give you the number of units of the what? The loan note. And a unit is 100 cedis. So this is how you do it. 15 over 100 multiplied by 100. Or it can be 100 over 100 multiplied by the number of shares that you are getting. And that will give us 15,000.
15,000.
Okay. This has not been recorded, isn't it? This has not been what? Recorded. So what will happen is that our loan note will now increase by 15,000 because the parent will now be having a liability, which is a loan note of 15,000. The two transactions has not been what? Recorded. The two transactions has not been recorded. So the parent will now be having a loan note of 15,000. But what are they saying here? None the outstanding interest on the loan note at 31 March 2006 has yet been what? Recorded by Tangent Co. Let's come here. So the loan note was issued on 1st January 2006. And the reporting period is what? 31 March 2006. It means that we're supposed to pay 3 months interest on the loan, isn't it?
That's correct.
Okay. But this has not been what? This has not been paid and this has not been recorded. It hasn't been paid and it hasn't been recorded. So what you have to do is that you have to calculate a 3 month interest on the loan and take it from the what? The profit of the parent. The parent is the one issuing the what? The loan note. The parent is the one issuing the loan note. So we go to the retained earnings and calculate a 3 month interest and take it away from the group retained earnings of the parent. Okay, so you have the interest on the loan note. The interest on the loan note to be 0.08 multiplied by 15,000 multiplied by 3 over 12. What are we having?
300.
300.
Okay, so you assume that this has been paid immediately. So if this has been paid immediately, what will happen?
It will be paid by cash.
Okay, so we go to your bank or cash and take 300 from here. Or if you also assume that it hasn't been paid, then it will be classified as a current liability. All right. Yes. Roxanne.
Okay, so please, with the share payment, the consideration they pay with the shares. Say please, the nominal value of the shares were once.
We don't really pay
But
attention to those ones. You just add a total value to your list. It should be 15,000 for the shares itself. Then you go and put 17,000 for share premium. But since they are not having share premium there, we just add the total shares to the equity shares, the 32,000 to the equity shares. Are you okay?
Say no.
The shares are at 1 cedi, isn't it? If you look at the existing shares of the parent, is 1 cedi. It's not 1 cedi.
Yes,
please.
Okay, so it means that the shares will be issued at 1 cedi. So it will be only 15,000 that will come to the equity. Then the remaining two, it was issued at 3.2. So the 2.2 will be a premium. Okay, then you go and you go and add it to a premium. But we don't really pay attention to that premium and those things. We just add all the 32,000 to the equity shares.
Okay.
All right. Roxanne, can I move on? Okay. So let's go. We are done with that now. We are done with the top there. So we don't have any problem going forward. So let's come to the footnote 1 now. Yeah, BC.
The statement, they said none of the purchase consideration has been recorded.
We have
So
done
the
that already.
finance cost that we debited the group retained earnings, I think is credit entry should affect the current liability rather.
We assume that it has been paid immediately. They are going to pay the interest. Okay. So they are going to pay the interest immediately. That's why we have taken the 300 from cash. Or you can treat it as a current liability. There is no problem with that because the question is not specific as to whether it has been paid or it has not been paid. Can I move on now? All right. So let's take the one now, the footnote 1 now. Okay. Yeah, Roxanne, footnote 1. Okay, if Roxanne is not there, Auntie BC, take the footnote 1 first.
At the date of acquisition, the fair values of Lati Co assets were equal to their carrying amount. However, Lati Co operates a mine which requires to be decommissioned in 5 years' time. No provision has been made for this decommissioning cost by Lati Company. The present value, that's the discounted at 8% of the commission, is estimated at 4 million and will be paid 5 years from the date of acquisition. That's the end of the mine's life.
Okay. So they are saying that at the date of acquisition, the fair values of Latico assets were equal to their carrying value. So there was no fair value movement there. However, Latico operates a mine which requires to be decommissioned in 5 years' time. No provision has been made for this decommissioning cost by Latico. The present value discounted. Okay, if you look at provisions, whenever there's a decommissioning cost relating to an asset, we find the present value of it and add it to the value of the asset. So the present value discounted at 8% of the decommissioning cost is estimated at what? 4 million and will be paid 5 years from the date of acquisition. So when are we having this information? When are we having?
January.
Okay, 1st January. So they said that no provision has been made. What should have been the entry? What should have been the entry relating to this transaction? What would have been?
You said we should have added it to the cost of the asset.
Okay, and what would be the corresponding credit entry? Okay, you create a provision. You are going to be creating a provision and you are going to be adding the value to the asset. So you have to count to the net asset now. Okay, this is not going to be having any effect on the net asset because asset will be increasing, liability will also be increasing. The 4 million will be added to what? To the mine. We are going to be putting a mine there. Okay, or you can add it to the PPE. There's no problem. Okay, because it's an asset that you are going to be decommissioning. So that will be added to PPE. But you have to, at the initial date, which is the initial recognition, should be debit the assets and credit a provision because you are going to be spending an amount in 5 years' time. So you have to be making a provision for that particular amount. You have to be making provision for that particular amount. So what you do over here is you can bring the PPE over here. At acquisition, how much was that?
Of the subsidiary?
Yes, it's the subsidiary that is operating the mine.
31,500.
No, that is 40, that is 4,000. The 31,500 has been recorded already. They are part of the net asset is from the book value that has been recorded already. The addition that has not been recorded. So this will be added to what? To this D2. Then you now count to provision. So the provision will still come. The liability will be increasing. So we now be having 4,000 here, and we now be having 4,000 here. The next item is this asset will be used for 3 months. So we count to depreciation. We are recording this on 1st January. So from the 1st January to March, we have used the asset for 3 months already. So we have a depreciation of 4,000 divided by 5 multiplied by 3/12. Okay, so go to your assets. Your asset is going to increase by 4,000. Then your liability will now come. Provision has not been recorded. So you now have a provision. You now have a provision over here of 4,000. Okay. Let's now go to a depreciation. We are recording this is recorded on 1st January, but the reporting date is 31 March. It means that we have used the assets for 3 months. So depreciation of 3 months should be charged. That will be 3/12. What will be the figure?
200.
The depreciation should be charged against what? Profit, isn't it? The depreciation should be charged against the profit for the year. And the profit is always at the what? You consider the profit of 2,000 is at acquisition, is at reporting. So we bring the 200 over here. Okay. The next one is we have a finance cost. Okay. We are going to unwind the provision for 3 months. We are going to unwind the provision for 3 months because it's a future value that we present value. So we have to be increasing it. So we have the future value at the end of the 5 years. So the 4 million is at the beginning. We now do a finance cost of 0.08 multiplied by 4,000 multiplied by 3/12. What are you having?
Eight.
Is what?
80.
Okay. So let's go to the statement of financial position now. Our value of the asset will reduce by 200, which is the depreciation. Our provision will now increase by 80. Okay. Okay. That is it. That is for that one. That is a IS 37 provisions. Okay. Let's go to the Roman number 3. The Roman number 2 rather.
Diligent core policy is to value non-controlling interest at fair value at the date of acquisition. Latico share price at the date can be deemed to be representative of the fair value of the share held by the non-controlling interests.
Okay. So they are saying that the non-controlling interest or the group policy is to value the non-controlling interest at fair value at the date of acquisition. Latrico share price at the date can be deemed to be representative of the fair value of the shares held by the non-controlling interest. So what will be the shares for the non-controlling interest? What will be their shares? What will be their number of shares?
5,000.
Okay.
5,000.
So they are saying that the 5,000 should be valued at the share price of what? The subsidiary. And their share price is 1.8. Okay. So their non-controlling interest, the non-controlling interest figure that we have there. Let's just straight about non-controlling interest there. So we have the fair value of non-controlling interest. Okay. So we have the 5,000. The total shares is 20,000. The parent is buying 15,000. So that will be 5,000 multiplied by 1.8. What are you having?
9,000.
9,000.
9,000. Okay. All right. So let's come to, yeah, I saw a hand up. Okay, the hand is down. Okay. So what will happen after getting here? Auntie Emilia.
Yes, sir. Please, I'm lost with the decommissioning.
Okay. The decommissioning, which
They were
side?
saying it was 4 million,
Okay.
and it has to be discounted by 8% in 5 years.
They have done it already. They see the
But I
present
don't know
value.
what.
They see the present value of the decommission cost. Okay. Let me read that one for you again. They have done the discounting already. Okay. So they see
I'm
no
seeing
provision.
multiply by 3/12. That is where my confusion was.
Yes, the provision will be made on what? 1st January, isn't it?
Okay.
But we
Okay.
are our reporting period is 31 March. So it means that
Okay.
we have to unwind it for 3 months.
Okay, I now get it, please.
Okay. All right, thank you. Yeah, Benjamin.
Yeah, Sinalanos.
Yes, please.
Please go to the group retain earning. Let me see something. Yeah, the 300 is it not going to be deducted?
Sorry. Okay.
Okay, thank you.
All right. So it's supposed to be it's an interest that will reduce the profit. Thank you. Okay. So so what you do is that after getting the non-controlling interest, you can now find your goodwill. So you have your non-controlling interest here, you add it here, and you bring the total net asset. That will give you 9,000. What will be the total value of the entity?
$56,000.
Okay, 56,000. Okay, so you can scan through to see whether you are going to be getting any other net asset. But I don't think there will be an issue that will be affecting the net asset again. So what you do is that you can quickly take your net asset because there's no going to be any adjustment to net asset at acquisition. So you can quickly go and pick that figure and now determine your. So what will be the net asset?
Are you not going to have unrealized profit there, if there is any?
The unrealized profit will not affect the acquisition figure. It will affect the reporting figure.
This thing, it will be 45,000.
Okay, that will be 45,000. So the 45,000, you can just pick it. You can just pick it and bring it to this place as net assets. So this is your net assets, which is 45,000. What will be the goodwill?
11,000.
Okay. The question is saying that there is no impairment on goodwill. So you just move on and put your goodwill here as workings, maybe workings 3. That will be 11,000. Okay. So we are done with the NCA also. Let's come to the III.
III.
Okay.
The inventory of Lati Co includes goods bought from Dan Co for 2.1 million. Diligent Co applies a consistent markup on cost of 40% when arriving at its selling prices. On 28 March 2006, Datan Co dispatched goods to Lati Co with a selling price of 700,000 These were not received by Latico until after the year end and so have been not included in the above inventory at 31st March 2006. At 31st March 2006, Dargent Co record showed a receivable due from Latico of 3 million. This defect to the equivalent payable in Latico record due to the goods in transit. The intra-group reconciliation should be achieved by assuming that Latico had received the goods in transit before the year end.
All right, thank you. Thank you. All right, so we are having two issues here. One of them is that the goods has actually been sold to Latrico, and one of the goods has been dispatched, but are yet to be received. So we are going to be looking at it one by one. Who is selling? Who is the seller here?
The parent.
Okay, is the parents. Okay. So they are saying that the inventory of Latrico includes goods bought from Targent Co for 2.1 million. That is a closing, that is a closing inventory that they are talking about. So it means that the goods with a selling price of 2,100 are yet to be what? Are yet to be sold. Okay. So, but what happened is that the parent, at the time that the parent is dispatching all these, the parent has already recorded all the profits. So portion of the goods has not been sold. So we have to find the profit on that particular one and take it from what? Our retained earnings, because we recorded all the total what? Profit on the sale. Okay. So they are saying that Targent Co applies a consistent markup on cost of 40% when arriving at selling prices. Markup is applied on what?
Cost.
Okay. And what are we giving here? Is it the cost price that we are giving, or we are giving what?
Cost price.
Giving the selling price.
So we have
Selling
to,
price.
so
Selling price.
margin is applied on selling price. So we have to change the markup to margin. We have provision. Okay, let me bring the provision for unrealized profit here. So let me just, since I've left this particular space, I'll put provision for unrealized profit. So let's change markup to margin now. Let's change the markup to margin. Okay, what we have to do is that markup should always be higher than the margin. So I don't know if I should tell you should memorize it or not, but what I want to tell you is that markup is always higher than what? The margin. So if you are changing, you either add or subtract. So you do it and see the percentage that you are getting, is it higher or is lower? If you are adding and the percentage that you are getting is lower, it means that will be the margin. But if you are subtracting is higher, that is not good. So if you are changing from markup to margin, you add the percentage to the down. What you do is this one. You have 40 over 100. Okay, but you add the numerator to what? To the denominator again. So that will be 40 over 140 multiplied by, this will now give you the margin, multiplied by your goods that are yet to be sold, which is 2,100 or 2.1 million. Okay. What are you having as a provision for unrealized profits?
600.
Okay. So that will be 600,000. So this 600,000 is included in the group retained earnings because it's the parent that is selling. So we have provision for unrealized profits. There will be another one. So let me just put it there. The goods should be carried at cost. The subsidiary is carrying the goods at selling price. So you count to inventory here. You take 600 here. All right. That is the first part of it. Very simple. Let's go to the complex side of it. That is for this question, that side is only the complex side of this question. Okay. On 28 March 2006, Targent Co dispatched goods to Latrico with a selling price of what? 700,000. These were not received by Latrico until after the year end, and so have not been included in the above inventory at 31 March. So this is goods in transit. The goods has been dispatched. It was 2 days to the end of the year. So maybe the goods were not able to reach there. Maybe it might be from Ghana to to maybe Ghana to where that they will take 2 days. Maybe they are using car, they are using road. So maybe Ghana to South Africa or maybe Egypt. So they are taking like 4 days or 5 days. So the goods has not been received. The goods are still in transit. By the time that these goods has been dispatched, how would the parents record this particular transaction? If the goods has been dispatched, the parents will record this transaction as what? They are not receiving cash.
Sales.
Credit sales.
They will credit sales and debit what?
Receivables.
Okay, so they are going to be debiting receivables and crediting sales. So if they are crediting sales, it means that they are assuming that all the goods have been sold. So the profit element there will be in our what? In our sales. Okay, will be in our sales. But none of these goods has been what? Has been sold, isn't it? None of these goods has been sold. The 700, none of them have been sold. So it means that the profit that the parents recognize on this particular item has to be removed. So let's go and remove that one before we come to the other issue. So let's come to goods in transit. Goods in transit. The parents will recognize these as debit receivables and what? Credit sales. Included in the sales is what? Is profit, which is here to be what? Realized. So we now come here and still have our 40 because they are using the same markup. 40 over 140 multiplied by 700,000. What are you getting?
$200.
Okay. So this will be 200,000, and that will still be, we go and now take it from our days. So the total unrealized profit will now be 800. Okay. Let's go to the question now. And so we have taken the profit element now. We can't go and take it from inventory because the goods have not been what? Have not been recognized. The goods should have been received by the other person and what? And the person will what? Will now recorded it. But the goods has not been recorded. So we come to a side where we take that particular one into consideration. But we first of all have to remove the what? The unrealized profit on it. All right. At 31 March, Sergeant Cool's records showed a receivable due from Lottery Cool of what? 3 million. This differed due to the equivalent payable in Lottery School receivables, Lottery Cool's records due to the goods in transit. So if the Sergeant Cool receivables is 3 million, what will be the Sergeant Cool's payables? What will be the corresponding payables based on the information that we have?
It also be 3 million.
No, please. This differed to the equivalent payable in Lottery School records due to the goods in transit. The time that they are transferring these goods, the parents debit what? Receivables of 700. But the goods are yet to be received by Lottery School. So if the goods should have been received, Lottery School will also go and add the 700 to their payables. But they are yet to receive.
So that should be 2.3.
That would be 2,300.
No, I think
that will be, so the payables of Lottery School is what? 2,300. They say the difference is due to the goods in transit. So the time that the parent is dispatching these goods, the parents debited receivables and credit sales. But these goods are yet to be received by the subsidiary. So the subsidiary has not passed any record for this particular transaction. So the 700 that should have been added to their payables is yet to be added. So their payables will be 2,300 in their books. Their payables will be 2,300 in their books. Okay. The intra-group reconciliation should be achieved by assuming that Lottery Cool had received the goods in transit before the year end. We know that based on the question, Lottery Cool has not received the goods, but they are now saying that we should assume that Lottery Cools have received the goods. So if the goods has been received by Lottery Cool, what will be the entries that Lottery Cool will be making? If the 700 goods has been received by Lottery Cool, what will be the entries that the subsidiary will be making?
Okay, so it will be increasing their stock and their payables.
So we debit the inventory by 700 and credit the payables by 700. Is that correct? Okay.
Yes, please.
So what we do now is that we go to the statement now and their payables. So inventory will now be increasing by 700. Okay, we count the inventory later. And their payables will also be increasing by what? 700. Okay. But what should have been the cost of the inventory? Inventory should have been 500 because there's a profit element of 200. Okay. So the inventory should be recognized at 500, not 700. So you will now bring in the unrealized profit of the 200 on that particular inventory. Okay. What is going to happen? Our receivables and payables are now the same. What do we do?
We
Cancel.
add the difference to the receiver.
We cancel now. Okay. The receivables is now 3,000. The payables has also now been increased to 3,000 because we have 2,300. We added 700. That will now be 3,000. So we cancel the what? The intra-group balances. We cancel the intra-group what? Balances as so. Please, why are we not recording the goods of 7,000? We have done that. Okay. So that is we now remove the what? The intragroup of you now remove the intragroup balances. Okay. But this is how we are going to be doing it based on what the question is saying. Assuming they are saying that you should not carry out this, assuming that the balance has been recognized. This is what you are going to be doing, or the goods has been received by the subsidiary. If that is not being said, if that is not said, what will happen? This is what you'll be doing. Okay. If that is not said, what will happen now is that we'll be having 3,000 in our receivables. So this is the entry that you'll be passing for that particular transaction. You will now debit inventory at the cost. You debit the inventory at a cost of 500. Okay. Then you will now debit the payables. The payables, what they have over here is 2,300. So you just go and remove that 2,300 because the goods has not been received. So we just remove that 2,300. Then you now debit your group retained earnings because there is an unrealized profit of 200 on that. Inventory should be valued at cost. So it's 700. So the unrealized profit. So you now debit your group retained earnings. You debit your group retained earnings of 200. Then the next one will be credit your receivables of the 3,000. You remove all the 3,000 from the receivables. So you see that the debit side and then the credit side will be the same. So you are going to be removing 3,000 from the receivables. That is the receivables that they have there. But the corresponding payables is what? 2,300. Go and remove the 2,300. You can see that the receivables will now be 700 more than that. 500 will come in. That 500 that will come in will be an asset. Remaining 200, that 200 will now be the unrealized profit. So assuming they say you should not pass this transaction, assuming that the goods has been received by the subsidiary, what you do is that remove the 3,000 from the receivables, go and remove the balance that they have in the payables, which is 2,300. There will be a difference of what? 700. This difference now, unrealized profit will be 200 on the goods. And the inventory will now be what? Now be valued at cost, which will be 500. So that will be the balance on that. Okay. But since they are saying that we should do this as if the goods has been received, then you have to pass the entries for the subsidiary before you do the necessary adjustments. All right. So that is the important side of this one. Okay. Let's take the last one.
The investment in Amerco represents 30% of its floating share capital, and Dargent Co uses equity accounting to account for this investment. Amerco profit for the year ended 31st March 2006 was $6 million, and Amerco paid total dividend during the year ended 31st March 2006 of 2 million. Darden Co has recorded its share of the dividend received from Amerco in investment income, that's in cash.
Okay. So this is investment in associates, and they are using accounting method. All right. So the first thing that is that you have to go to your investment in associates, and so investment in associates. So you bring their share of profits here. So the share of post-acquisition profit, that will be 0.3 multiplied by 6,000. What are we having? That is the share of the profits.
1,800.
Okay, 1,800. Let's go to the dividend side now. Okay, you can see that the share of the profit is before dividend, isn't it? The share of the profit is before dividends.
Yes.
Okay, it means that the share of the dividend is part of the 1,800. But they are now paying a dividend of 2 million, and you're also taking a part of that one. So it means that the share of the profit in actual sense should have been 4 million, because we are going to be receiving a share of 2 million, which is the dividend, and we are going to be receiving the share of 4 million. So it means that at the end of the day, we are receiving a share of what? 6 million. Dividend is paid out of what? Out of profit. So if you're having the share of the profit, it means that you are having the share of the dividend together with the profit, because the dividend of 2 million is included in the 6,000. Okay, but now you have a share of dividends. So it means that if you are having a share of this, you are going to be telling us that you are going to be having a share of 6 million, and you are going to be having a share of 2 million. In actual sense, you are having a share of 8 million, but 8 million is not the profit for the year. The profit for the year is what? Is 6 million. And you having a share of that, it means that you are having a share of the profit together with the dividends. Okay, so they now have the dividend, the share of dividends. The share of dividends will always what? Will always reduce the investment. It's just like you have an investment in a company and they have declared interest, but you went there to what? To withdraw part of it, it will reduce. So this particular thing has been paid to them as dividend. They have actually paid a certain amount of their investment to them, and that will be 0.2 multiplied by 2,000. What are we having?
600.
Okay, that will be 600. Okay, so your total share of the profit is 1,800, but they have paid a dividend to you. So if they pay the dividend, what will happen now is that you'll be debiting your cash and you'll be crediting your what? Your group retained earnings. Okay. But the people that
dividend again for me.
Okay, I'm saying that the dividend is always paid out of what? Profits. So it means that your share of the 6,000 dividend is already included. Okay, but they have paid a dividend. The people that are paying you this amount, this is what they are going to be doing. They are paying you a dividend, and you are accounting for this using equity accounting method. So from the perspective of the associate, this is what they are going to be doing. They are paying you a dividend. The entry that they are going to be passing will be debit your investment. They will debit your investment. So they will debit investment of, they will debit the investment of, no, they are going to be, they are paying dividends. So they will not debit the investment. They are paying dividend. This will be the entry. Okay. So they will debit their profit or loss, which is that one with the 600. Then they will now credit cash. Okay. They will now credit cash. Okay. They will now credit your cash, or they will credit cash of 600. That is the entry that they will be making. Okay. That will be the entry that they will be making. In their books, they will be removing this from the investment. Then they will now be what? They will now be crediting their cash. That is the entry that they are going to be making in their books. The subsidiary, that is the entry that they are going to be, the associates rather, that is the entry that they will be making in their books. Okay. But you are going to be receiving this particular dividends. If you receive the dividends, it will be in cash. So you debit your cash, okay, which will be 600, and you now credit your profit or loss or group return earnings with the 600. Okay. But the question is, let's come here. The profit that you are going to be receiving, the share of the profits that you are going to be receiving from these people will be, you debit your investment. You debit your investment of 1,800. Then you credit your group return earnings. Okay, your group return earnings of 1,800. Okay, but what is happening is that you are already crediting your profit or loss of 600, but this dividend is declared out of the current year profits. So it means that the profit is 6,000. Before you even receive the dividend is already part of the 1,800. The dividend is already part of the 1,800. So you'll be bringing the 1,800 to group return earnings, and you'll still be bringing the 600. What you are telling us is that you are having a share of what? The profit for the year, which is 2,400. No, but the actual profit, the share should have been 1,800. The share should have been 1,800. But what you are going to be bringing is that you bring a profit of 1,800 together with the 600. That is 2,400. But the profit is 6,000, which your share is 1,800. Why? Dividend is paid out of what? Out of the profit. So it means that in actual sense, your share of the profit should be 4,000, and your share of the dividend should be what? Should be 2,000. Okay, but since you are having the 1,800 over here, where are they going to? How will they pay the dividend? The dividend will be paid out of the profit. You are going to be receiving the dividend as cash. You are going to be receiving the dividend as what? As cash. So if you are receiving the dividend as cash, what is bringing the dividend? It is the investment. So your investment will be reducing. They are giving you cash of the investment. The investment will be reducing. So the amount of the profit or the interest that you are having there will be only 1,200. You have investment in the bank. The bank is paying interest of 1,800. And you went there to take a cash of 600. It means that the portion of the interest that will be remaining for you will be what? 1,200. You are taking the cash out of what? The interest that has been what? That has been given to you. And that's why we are taking the 600 from what? From the investments. So the dividends will always reduce the what? The investment in associate, because they are paying you part of your what? Your amount that is with them. They are paying you part of your amount that is with them. Okay, so let's come to this side. Let's come to this side. Let's come to this side. So what will happen is that the share of the profit will always increase the group return earnings. But this is what we are going to be doing. So we have the share of MA Co, the share of the profits. Okay, that will be 0.8 rather, 0.3 multiplied by 6,000. What are we having? We are having 1,800. Okay. Then you come to dividends. They say the dividend is already what? The dividend has been debited. The dividend has been, Targent Co has record each share of the dividends from Amico in investment income. So after the investment income, where would the investment income go? Where will it go for the parents? Where will the investment income go? What will the investment
part of the group? It will be part of the return earnings.
Okay. So it means that the 600 is already part of this one. So if you are adding the 1,800, that means that you are recording what? 2,400. But the actual share should be 1,800. So you come and take your dividends, because the dividend is already part of the profit. But the dividends have been added to what? The group return earnings already. So you should have sent what? 1,200 over here to cancel everything. But what we do is that we show them at the total. So your 1,800 will come, adding to the dividends already, will give you 2,400. No, but your actual share should be the profit 4 million and dividend 2 million. But you are telling us that it's 2,400. So you come and remove the 600 from there, and you have your share. So this is how you go for this one too. This is how you go for this one too. So the dividends should always be taken from the investment income because you are withdrawing part of your investment. They are paying you cash of the profit. So that will not be there. The people are not going to be owing you anything. The people are not going to be owing you anything. So that will be reducing from that side. So that is the end of this question. All profit and loss accrue evenly. That is for the calculation of the group retained earnings. There were no impairment losses doing within the group for the year end. So let's go and determine our post-acquisition profit and other things and move on. Okay, so this was the figure that we used over here was 45.
5,000.
Okay. So this will be what?
$28,720.
Can you take it again?
28,720.
46,720.
40 what?
6,720.
46, 720. Okay. The post-acquisition profit is 1,020, isn't it?
720.
Okay. All right. Another way of calculating the post-acquisition profit is this. What is the profit? What is the profit made for the post-acquisition period? What is the profit made from January to December? January to March, rather.
2,000.
Okay. That profit was 2,000. What were the items that happened during the post-acquisition period that were not adjusted? We have a depreciation of what? 200.
Depreciation of 200.
So you can just take the 200.
And finance cost of 80.
So we have finance cost of 80. So you can just adjust your post-acquisition profit like this. This is how I used to find my post-acquisition profit. I don't have time to come and be doing net asset at acquisition at a reporting. I only do net asset at acquisition when I'm calculating my goodwill. So you can just take your post-acquisition profit. It's 2,000. January to March is 2,000. What are the items? What are the transactions that happened during that particular period, January to March, which will affect profit but was not taken into consideration? Then you now adjust it against that particular profit because they are not part of that profit. So you now adjust it. So you are having 1,720 as the post-acquisition profit. So you come here, you have the share of PEP. That will be 0.25 multiplied by 1720. What are we having? Share of,
0.3 or not 0.25.
no.
0.25.
This is the profit for subsidiary. So 0.25
Okay.
multiplied by 1720.
430 for NCI.
430 for NCA. So 9430. Okay, the parent is what?
1290.
1,220.
Okay, total it. Let's come here. This will be 5,700. So plus 1,200. So 5,700. NCI will be workings 4, that will be 9430. The parent, this one will be 82,000. The group return is how much?
Okay, I am getting 37,390, but maybe somebody to can cross check.
Okay, 87 there is too much. Huh?
37.
Okay, 37.
37390.
390. Someone should confirm that. Let's move on. So workings 5, 37390.
37,390.
Okay. So you have your, okay, so that is it. Just come and put your figures together. So provision will now be 480. And your liabilities will be what? Current liabilities will be what?
Senior provision 4080.
4080. I'm getting
Yes.
31 something.
No, the provision, because the 4,000 we carried.
So that will be 4080. That 40, 4080. Okay. So 24,000 plus 16,400 plus almost 2,200.
Current liability 8,100.
Okay. Now current one is 20,000. Okay. The loan note is 20,000. So 82,000 plus 37390 119390 plus 9430 plus 20,000 plus 4080 plus 38,100 191,000 total equity and liability. Yes, please.
They said the 42,000. Are you not going to split it into separate money?
I can't hear you.
I said
Yes, please.
the static capital. Are you not going to split it into two? The self premium and then self capital.
No, please. If you do it like that, no problem. But we always add. We don't pay attention to that. Okay. Plus 600 minus 300.
37.
Okay. This will give us 1,500. And our receivables, 14,700 plus 12,500 minus 3,000. I'm having 23,500.
I'm getting 24,200.
The receivables?
Yes, please.
Is 14,700
It's
plus
24,200.
Okay. Minus 3,000. Okay, 24,200 rather. Okay, 24,200. So let's go to the inventory there. 19,400 plus 18,800 plus 700.
5,000.
I'm having 38,100.
38,700.
700 or 100? Okay.
100. 38,100.
Okay, 38,100. Okay. come to your PP 75,200 plus 31,500 plus 4,000 minus 200. I'm having 110,500.
Yes, confirm.
Okay. 110,500 plus 5,700 plus 11,000. 127,200. Okay. So 38,100 plus 24,200 plus 1,500. You'll be having 63,800 plus 127,800. 191,000 total assets. All right, so this all for this question.
Please, can you go back to where the inventory is? I want to check something. Okay, thank you.
All right.
38.9.
All right. So
Snellano,
yes, please.
will you share the working sheet with us?
Yes, please.
Okay, thank you.
All right. So
Please go to the next page. It's okay.
So we will take our next question on statement of financial position on Tuesday. All right. So thank you all. I'll see you guys.
Thank you very much. Please, I hope you share the video today.
Is that?
Please, I hope you will share the video today.
Yes, please. Yes, please.
Thank you very much.
All right. All right.